All right, hello. It's been a while since I've posted, but I think this is a good time to look at some of the events that have been happening in the markets. I think it's an interesting time. So I want to go through some charts and also just give my thoughts on where the market is going now, what the economy is looking like right now, and so on. So to start out, we have the S&P 500 obviously has been undergoing a correction on the shorter time frame. It looks like it's broken down from this head and shoulder looking pattern after a rally that's lasted really basically from October of 2022 to July of 2023. So right now it's October 28th, 2023. And what we can see is the S&P has been selling down. It's coming in right into some pretty strong levels of support. It's not only, price support, but also volume profile support. So if we bring up the volume profile for this range, let's see. So for the past few years, bring up a volume profile, and you can see high trading volume just below where we are sitting right now. So I think what this tells you, we've had high levels here, and you can see those have been chop ranges, price chop ranges. Usually price stalls around those areas at least. Sometimes it reverses, bounces. It acts as kind of a soft support level, resistance level. So what I'm seeing is a very potential bounce coming into the next few weeks to where this S&P stops. And maybe who knows how high that bounce goes. It could go, all the way up to the 430s. It's just hard to say. If you look at the VIX, which I think comes in, you want to see in tandem with this S&P, we're at a level where it's a potential top. So you can see, let's go a little further out. You've got this bigger picture. You've basically got this trend line that's gone all the way back to November 2017. And the VIX has respected that trend line until April of this year. And we've been trading below that line ever since until recently. So this is interesting. It tells two things. It says, one, one is that there has not been a lot of fear in the market. There's been, it's been a pretty complacent summer for this market, and that's allowed the market to sort of just move up without much issue. And you can see how that on the price action May all the way to July. Even after July, it just went sideways until September. And you can see here, this is where the VIX really popped on September, was when we got more of a flush down in the S&P. But right now, we're right at this sort of in-between point where it's violating this this long-term trend line, which tends to happen as the VIX changes trend. It ignores the trend line for a while before making its decision on where to go next. Now, I think because of that, it can go either way. So I basically looking at like the RSI divergence here and just previous patterns, it could very well be a topping pattern, and then we maybe see, let's see, maybe see something like this where the VIX goes back down again for a while before eventually popping out and seeing more of a market crash scenario, or it could go sideways for 2 years. This is just looking at the chart. Another possibility is we eventually break through here, and then I think you can see the secondary trend line that the VIX has been following. I think once we break this trend line to the upside, if that happens, then we're going to see a huge sort of black swan type sell-off in the market, 10-20% in just a number of weeks. So those are kind of the two scenarios I see just looking at the S&P and the VIX together. Something else to take note of is if you go into the ES chart, which I like to use for longer time frame, bigger picture stuff, we zoom way out, and this is the ES, right? Yes. There's this trend line or this trend channel that we've more or less been in, with the exception of a few events since 2008. First event was the market crash. We quickly recovered and basically formed this trend channel. It briefly dipped below in 2018 during that small market crash, and then again during the COVID market crash. Since then, it has made its way to the top, popped out just a little bit above the top, and has come down. And what's interesting is, I think this is really significant, is that we have broken below the trend channel once again with the 2022 market sell-off, and we've stayed below there except for a quick period of time from, I guess, June to September, where it's failed again, which tells me that this channel is no longer valid, which means most likely we're either going to see a shallower rise, sideways action for a while, or a downward action. And depending on how the market fundamentals play out, I think that, obviously market fundamentals being the strongest factor in where you ultimately go, means we sort of have to take a wait and see approach and see how fundamentals play out. There's a lot of things with how the U.S. handles its debt situation, how we handle the next recession, how we handle interest rate, and how high they've hiked. Will we see a global recession? And if so, how quickly will governments step in to sort of provide stimulus, if you will? Basically, how much borrowing will they do in order to try and bring us out of the next recession? And I'll get to that a little bit more towards the end of the video, what my thoughts are on that. I think moving on to the, initially, I think right now, just short answer for this, where I think this will go next is, I think because we broke this, we could see a much bigger flush down, like maybe even something like an ABC type pattern where you've got two big legs of a market sell-off. So maybe we see a deeper market sell-off here, or one that's similar to the 2022 sell-off. It could be possible that this is a sort of large double top, and if that's the case, then the sell-off, once we break below around this lower level where the market bottomed back in 2022, then we could see a much more significant sell-off, something closer to maybe maybe looking like this, which would be from the recent top a 44% sell-off, which isn't really, that's not unheard of. And it would come to right down into around the area where the market has bottomed previously. I would not be surprised if the market stopped selling off there, but again, it's entirely, I think, determined by the fundamentals and how governments deal with what is coming. I am generally bearish in, the next 6 months, mostly because, I think the technicals show that the market is sort of slowly turning from an uptrend to sideways or down. And also because the fundamentals show that in similar situations as we are in now, the market just doesn't do well. So we have this look at the VIX and the S&P. Going over the Qs, I mentioned that the S&P was selling off and it looked like it was sitting on support. It doesn't quite look like that for the Qs. And actually, I think it would be useful to do a volume profile here just to see where the big levels are. It looks like these red levels are something I put here previously. Let's just redo all the red levels. And actually, maybe all these levels of support. Just redo all of this. Make it look pretty. All right, so the next volume profile level is here. As far as I can tell, support and resistance levels, if we get rid of this, major level of support / resistance, maybe right here. Okay, so we kind of are sitting on a big potential support level, which I hadn't seen before. But if we break below this, maybe something here. I'm gonna make this. Maybe something here. It's kind of a chopped area where if we break below the current support, I can easily see this falling all the way to around 316, which would be another. Can we get this measurement? Okay, another 8.5% or so before seeing, I think, more of a firm bounce level. So I guess what that says is the next week or so is going to be pretty crucial, probably the next 2-3 weeks. See, do we get more of a sustained bounce, or does this form more of a bear flag pattern, go sideways for a while, and then continue the sell-off? Looking at this chart alone, shorter term, I'm kind of inclined to say this continues to sell off. Part of the reason is this sort of soft trend line support has been broken to the downside. But we'll just have to see. The VIX for the triple Qs, I don't chart this. It's a lot more messy and a lot less clean. I guess well, I haven't tried to chart this, but you can see there's all these long wicks. It's just, I don't think it's as reliable as the VIX. But this triple Q's volatility, you can see it's been sort of slowly rounding out the bottom, and it looks like it's kind of on an uptrend again. So what I see is a potential situation where S&P maybe gets a bounce. We have a rotation out of big tech into other sectors. Um, One thing to notice, I guess, if we go to the Russell or the RSP, which is the equal weighted S&P 500, if you go to the beginning of the year, which would be right about here, we're, 3% negative on the year. This this index has been doing horribly. If you compare that to the S&P from the beginning of the year, we are still up about 8.5%. So that's something a lot of people have been noticing, is that the top 7 stocks in the S&P, top 7 stocks in the Qs have largely been driving the market. The largely driving the sort of bullish market that has happened this year. So just looking at the equal weighted S&P, it doesn't look like there's a lot of support until we fall another few percent, 5% or so. I guess you can argue there's some level of support. So maybe we get a bounce here. But it's not very strong. We've got 2 reactions here. 2 horizontal reactions, and they're not major bottoms. They're just sort of intermediate bottoms. So equal weighted honestly looks worse than the S&P 500 as a whole, which is interesting because kind of what I've been expecting. Oh, and you can see there's more selling volume. Actually, the highest selling volume on this last week than... holy cow. Is that right? I don't know if that's right. But it looks like the highest volume since the index has started has been the last week. So definitely does not look good for the equal weighted S&P. We've got elevated volume on just the normal SPY, but not the same volume. I mean, not crazy volume. Okay, moving on to the IWM. This is the Russell 2000. There is what looks to be pretty significant support that we're in the zone and running into the zone. So a major top, another major top, a major gap zone from 2020, and as well as something that formed a double bottom in the last year in 2022. In addition to that, you have a potential area where, I say potential because this isn't, I kind of forced this into becoming a trend channel. You can see there's reactions all along there at the top. One major reaction at the bottom. The COVID reaction was sort of, it's hard to say whether that, where exactly that should lie, just because it happened so quickly and there was so much overselling. But there's a potential area where soon I would expect a reaction at the bottom of this trend channel within probably within 5 to 10%, 5 to 7%. I would expect a reaction to the IWM. So it could be that the IWM is going to find a longer sustained bounce soon. I guess I would go as far as saying if the IWM does break below this and continue downwards, that would probably constitute some sort of black swan event, some sort of event that the market's not expecting that causes a huge, fast sell-off. Something that is a little concerning is there is this trend line, not a very strong trend line. It's got 1, 2, 3 reactions that did get broken to the downside, and that's that could be a false breakdown. I don't think, I mean, after it's broken down this much, I don't think you could call it a false breakdown, but it has broken this trend line, and I guess we're waiting to see what it does near the next reaction area. Something else, I guess let's look at the Dow. I haven't spent a lot of time really paying attention to this, the Dow Jones, but let's see. Yeah, I haven't recharted this one in a long time. What it looks like to me is that if you do redo this a little bit, what are the main trend lines? What are the main levels here? I think, I guess this is kind of a downward trend channel that we broke out of, but you have this longer term top trend line that has, except for the 2021-22 time period, has acted as resistance to the upside. As far as support levels go, maybe we'll see something like this. So I can see a little bit more downside in the Dow Jones before any sort of reversal, at least down to 31,500. I'm not really seeing, well, let's see. We have this, which could be something. I guess you sort of follow that. That kind of creates a rising wedge. Another thing is that, you almost double topped here. I don't have any strong opinions on what's going on here from a technical level. It's sort of looking like, okay, I mean, you sort of broke two levels to the downside. We'll see what happens around 31,500 if it catches support there. Does it make sense for it to do something like this? Okay, that's a little extreme, but can we see, is this a big sort of rolling top that we're seeing here? That is possible. Might also be possible that this major range here around 29,000 becomes a bottom, and you don't see it go further than that, which would maybe look something more like eventually, we go sideways for a while. And eventually break out. I suppose that's possible. Again, I think it depends on the macro picture. The Dow Jones has a lot of industrial, larger, industrial companies, more physical companies, less so technology-based companies, and so I think it's a lot more tied to how the overall economy is doing in terms of its performance. Moving on to the ARK-K, which is the speculative, the more speculative, I guess, index ETF. We have seen a bottom. Basically, December 2022 was a bottom. Now, what it looks like, so there's this potential trend channel that that we basically topped out here from our 2022 to 2023 rally. It looks like we've had a top there. It also looks like this was another like uptrend channel, and then we broke that to the downside. So we'll have to see where this bottoms. I think probably the next potential target would be, let's see what it does at a double bottom, so somewhere down here. You can see we have some support just below where we currently are. I'm kind of leaning towards this breaking through that. Although if you do the projection of the breakdown there, it shows it'll come down here. So maybe it does bottom out here, and then we'll see a bigger bounce. As a whole, I don't think this ETF will do very well. Maybe it finds a bottom here and just sort of sits around there for a long time. But because of where interest rates are at, because of, well, yeah, mostly interest rates, because of the sort of economic downturn that I think we're seeing, I just don't think highly speculative companies are going to do very well for the next few years. So my bias is downside. The technicals say, yeah, basically, if we probably break this level again around 33, I don't think it's going to stop at the $30. I think it could end up going a lot lower. So I know I'm hopping around all over the place. I wanted to look at some ratio charts. Let's look at the more macro charts and then some ratio charts. So the dollar index. What does this indicate? I think there's a lot of companies that the dollar index correlates with or inversely correlates with. Big tech hates a higher dollar because so much of its business is overseas, and higher dollar means lower revenue overseas. And when I say overseas, I mean just anywhere foreign. So not necessarily overseas, but their foreign business or their business outside of the country suffers with a higher dollar. So in general, I think the market's like sort of a stable dollar. So if the dollar is ripping, that's pretty bad. If it's tanking, that could be, bad from an inflationary perspective. But longer time frame, you can see, basically monthly time frame, more basically down to 1985 or back to 1985. We've been in this sort of, this funnel pattern. In April of 22, we broke out of that pattern, topped out in September of 2022, and now we're after a big consolidation period. This isn't a high confidence trend channel. In fact, it's pretty low confidence. It probably should not be here, but you can see we've kind of consolidated sideways and then broken out from that consolidation range. You can see there's a pretty clear, this is something that's clear. Let's just get rid of this for now. What is clear is that we had this narrowing range, a short false breakdown down to what I think is a major level of dollar support, 100, 100, very, very round number support area, and we've broken out again. And so from what I can see is there's no telling where this tops out. It's been a very, very steady rise. I think we're kind of due for a pullback, and well, we've had our pullback, and this hasn't been an extreme pullback. So what I think this is showing is that it goes sideways until it breaks out to the upside again. It's not really characteristic of a top, this sideways range. It's more of a sort of bull flag from what I can see. So my expectation is in the next few weeks to maybe a couple months at most, the dollar breaks out to the upside again. How far does it rise? That's a good question. Maybe we can be a little conservative and say something like this. So 110-ish. I don't think that's going to be good for equities in general. I don't think the market's going to like to see that. So where do you see potentially good news is in the TLT in treasury yields. So on a daily chart, you can see, well, let's go big picture first, just because it's been a while. So we've had this long uptrend in the TLT. Something strange has happened to where these lines lie. Maybe not. Maybe it was supposed to be there. I think that's good. So we've had this long uptrend, broke it with a kind of head and shoulders pattern, and we've been just diving ever since then. You know, small rebounds, pretty good tradable rebounds, but in general, the trend is now downwards. I wonder if you can even have a, like, is it something where we can potentially put a trend channel on it now? Maybe. It's hard to say. Something like this. We're in this downtrend channel. Short term, what I was going to say is I think there may be good news in that it looks like we've got a divergent RSI bottom here. So slightly lower low where the it looks like the selling pressure is sort of starting to fade away, and we could see a more significant rebound soon. The question is that good for the market? Because everybody wants interest rates to go down, but what's the context of the interest rates dropping? If in some sense the Fed drives interest rates, it drives interest rates less and less the further out in duration you go. So 10-year yields, I don't think that's really affected by what the Fed is doing. I think it's a little bit, but not that much. If 10-year yields decide to drop, what that probably means for the economy is they're expecting a recession if it suddenly tanks. But you can see this potential trend channel. Like I said, it's potential because there's not enough reactions to where I have much confidence in it. But if we follow this potential channel, then I think we are at a top here. Longer term, I would expect a definite top around 2.79%, or sorry, 5.279% or 5.3%. And the reason for that is because we've got some major bottoms and major kind of tops historically going over the past 20 to 30 years. Where this is sitting right now, if it is following this trend channel, then the only way I could really see that happening is if it's going to take some time. Basically, the earliest that could happen is May of next year that it tops there. I think short term, more likely is we see something like a big pullback, maybe all the way back to here, and the 10-year yield kind of inverses the TLT. It doesn't include the 30-year yields, but 10-year yields and 30-year yields are generally similar in the way their price action is. The point being is that it looks like we may be topping out here in yields short term. And so I would not be surprised to see this drop significantly. If you go to 2-year yields, this chart looks much more wild, I guess, in that I think we've been topping since October of 2022. Like, we've barely made, like, rip from almost 0% all the way up to almost 5%. And then since then, we've been staying in a very narrow, well, not narrow range, but we have not, I guess, a wide range with just very nominal new tops or very marginal new tops. We most recently topped at 5.2, 5.3%. This is a very common topping pattern, is this sort of high volatility range with marginally higher highs. If we go from the weekly to the daily time frame, you've got this narrow trend line, or this very very narrow range trend channel, or I guess rising wedge, if you will. Recently, we gave, I guess, one attempt, two attempts, and a third attempt to break down from it. I think it's quite likely that this breaks down and flushes down pretty quickly. And why I bring this up is if you see short-term yields flush down quickly, that usually means a crisis type situation. I guess most recently was COVID with February and March, just a very sharp sell-off. 2007 had a much more elongated sell-off. If we remember, the market crash during that time was in September, so it had been selling off for quite a while before that market crash. Around 2000, these yields topped and went down, so I think all throughout the bear market of the dot-com bubble, or following the dot-com bubble, these yields sold off. And if you go to, I guess, the yield curve, or the spread between the 10-year and the 2-year, you can see this chart only goes up back to 1988, but we have been the most inverted since the 80s. I think there's only a few examples in the past 100 years that we have been this inverted. And recently, we are very rapidly coming out of inversions. We've passed the past the spread of the I guess March of this year, which, if you remember, was basically the mini bank crisis with the Silicon Valley Bank and a few other banks, where the Fed had to come in and bail them out. We're past that, and if this continues, we're like a week or so away from a complete reversion to positive yields, which generally correlates to around the time where a big market sell-off happens, plus or minus 6 months, but 6 to 12 months actually, probably a little more than that. So it's the whole yield curve inversion thing doesn't let you time big sell-offs very well, but it lets you prepare for them, I guess, in that you expect something big to happen in the market somewhere around, I guess within 18 months of these inversion points. Okay, so I think, actually, let's look at this. The M2 money supply. This is also interesting to see. I hadn't planned on looking at this, but it's interesting nonetheless. We, since this started being charted, I guess back in 1960, since this data has started, 1959, we have not seen this sharp of a decline in M2 money supply, period. It just hasn't happened. Now, we also haven't seen this steep of an increase in the money supply that we saw, period. Like if you look at this, let's just say bottom, well, let's just look at the steepest period part of this. Have we ever seen this steep of an increase? Like for a very short period of time in 2011, yes. Maybe very briefly in 2008, but not for that long. So that's the first interesting point. I guess what I'm trying to point out is that we had a huge surge in money supply, huge surge during the COVID events. And now we've had a pretty significant shrinkage, but it's still not back at trend. Even, even having the biggest decrease in M2 money supply, I think on record, we still have not come back to the trend line. So that's, I think that's concerning in two ways. One is that if this follows its natural course, then it probably will come back at some point, which probably means further pain for the market. And this, just looking at the M2 money supply, leads into my next point, which is if you look at ratios, there's some very concerning ratios. Let's start with the S&P to M2 money supply. This is all time, I guess back to 1959. We have only seen the S&P go above recent levels once, and that was the dot-com bubble, which arguably maybe it was the biggest bubble in U.S. history. Possibly worse than 1929. I guess if you looked all the way back to 1929 and saw this, if we had a comparable measure, we could see. But I think the dot-com bubble was pretty similar in severity to that bubble. We have recently ticked up this, or brushed up, I guess, bumped into this horizontal level of resistance on the S&P to M2 money supply ratio. That that was a potential topping pattern. Like during the time, what it looked like was a potential topping pattern, but it's hard to say how long the top will last. But once we've broken, below this level, no further chopping around, breakdown. I think that's, to me, this is the most compelling evidence so far that we've seen a market top. To see this come back from here would be quite a surprise to me, just because it doesn't seem to happen very often until there's a big sell-off. The other thing is that if you go back to the 70s, which was, like, I would say the big inflationary period was early to mid 60s to late 70s was when inflation was the worst. During that period, from 1961, the market sold off or the market sort of stayed around these levels on the upside as a limit, and each sell-off sort of got worse in terms of being compared to money supply until, eventually 1982 it bottomed. So this was like a 21-year period where the market got worse and worse in terms of M2 money supply. So um, if you compare the market in nominal terms, where you don't consider inflation, the market did okay-ish. Like, let's just go back to SPX starting in 1960. 1961 was back here. Okay, so the market looked like it was doing pretty good. Like it was doing decent. And then by 1966, we sort of got this period of just slightly higher highs and then lower lows, where this, I guess, this expanding funnel pattern uh, played out. But nominally, at the end of, I guess, close to 1980, 1980, you probably were not feeling too bad about your stock performance. I mean, it was a rough ride, but at least you were break even nominally. But if you compare that to M2 money supply, which is more, I think, long term, more correlated to like CPI and inflation, you were down quite a bit. Let's just multiply this so that we can get percent numbers. All right, let's go a little higher. Okay, so starting back 1961 to the bottom, you were down 73% on, your major index over a course of 30 years. And when I say that's roughly close to inflation. I'm not sure if the CPI, grows faster than the M2 money supply, but they're fairly close in terms of their growth rates. They're not, I mean, they're closer than just comparing it to nominal versus dollar. So the performance was horrible. So long term, it concerns me that we may have seen the peak performance in terms of the S&P, or sorry, in terms of money supply, and that from here, like, you've got this clear sort of trend line support here. Once that gets broken, I think it's game over for the market. So for now, we can be optimistic and we can say, okay, we'll eventually hit this trend line and we'll get a bounce. I think that's quite likely. After that, we could see this thing start to perform worse and worse over time. And if inflation remains high, which I think it's potentially will, if M2 money supply growth remains high, if interest rates remain high, I think those are the three conditions that you need to meet to have pretty poor performance of major indices over the next few decades. So for now, shorter term, we're sort of in range. Clearly, we're in the midst of a sell-off. I think I would not be super comfortable buying for more than like a week or two rebound until we hit this lower trend line, and then we'll take it and see from there. So this ratio SPX to M2 money supply does not look good. We clearly topped from my view. Looking at the NASDAQ to money supply, let's start big picture. NASDAQ is much more volatile and much shorter time period. So we only go back to 1985. I'm not sure when the NASDAQ was formed, but you can see a huge top in the 2000 bubble. And then since then, we bottomed in 2009, where after it's had a second sort of, so in the 90s, or you know late 80s, all the way up to 2000, it had one period of very good performance, and then it sort of was in a downtrend until 2009, where you know whatever the market conditions were, whether it be QE or just the market was ready for it, we had another big period of tech outperformance. But you can see we had our first top in 2021, and it's almost perfect double top very recently in August, July and August. And it's turned down from there. So I think from a purely technical perspective, I don't think you have to say it's topped, but I think it's like you could eventually break out of this. I think it would like take more consolidation. I would expect probably a pullback to at least the midpoint area before you break out. So shorter term, my bias is still that this turns down and stays down for a while. You have this sort of splitter trend line where there's a lot of reaction points, a lot of grinding through that central point, and we've just broken below that. So maybe we grind, like it's to me, it's most likely that we continue down. I guess that's my sort of base case in this ratio. But it is interesting that it topped almost at the same level the previous top was. And it followed sort of a clear trend line, or at least the most clear one you can have. That's what's astounding to me for these charts, is how cleanly the price action follows major trends. Usually, if you just look at nominal price charts or relative to dollar to price charts, price action can be a lot more messy. Something else to look at, TLT to M2 money supply. Now, we've said that what's interesting is if you've owned TLT since 2002, which is when this chart starts, up till 2021, when this broke down, you were basically break even in terms of money supply, which means you're probably break even. Let's see. Probably break even in terms of inflation. In fact, I want to go here and look at this chart is silver to CPI, and if we go to TLT to CPI, okay, so according to the CPI, the TLT, or the official CPI measure, the TLT has outperformed it. Which in my opinion, I think the CPI has been under tracking inflation. Like, sure, some things inflation has been spot on, but because they've rewritten the way the CPI is tracked several times over the years, I don't think it's a very reliable indicator. Like, I don't believe we're actually sitting on 4% inflation when like meat prices are up 50% or more. Like, the things you actually need to buy and eat are up far more than the CPI would indicate. But and that's over a few years. There's a little exaggeration going on in there, but I don't think the CPI tracks things correctly, or at least realistically, compared to what the average consumer has to pay. But that, I guess, going back on to topic, the TLT has had a massive drop, and it continues to be dropping compared to the money supply. Now, are we going to see a sort of bottom here? If this does reverse soon, I think it's potential that this eventually forms a bottoming pattern, chops around. Like if we reverse here and maybe see something like this, then okay, that could be a nice setup for an inverse head and shoulder, and we come back up. Right now, it's too tough to say. We could go to the weekly chart. The best indicator we have is the daily chart, which shows that it might be forming a shorter term bottom. So maybe this, maybe for a couple years, the TLT is near a bottom, or the TLT to money supply ratio. Next chart, we haven't even looked at gold, but since we're in ratios mode, this is interesting to see as well. So long term, gold has also, like this is another thing that makes me think the CPI is not that accurate, because gold is something that the demand has remained relatively constant over the years. The supply has remained, not too unchanging. And we had this admittedly very wide range for gold, but it still stayed within range since the 60s. During the dot-com bubble, I think gold was the most undervalued it has ever been. Or when I say ever been, it has most undervalued in this chart. So since like the 60s. But we've had a relatively good level of support here, where most of the time we have remained above it. And, every time you react, it bounces above. We had a brief, like this was what worried me for a while, was this brief period in 2022 where, well, brief meaning like almost half of 2022, where we broke below, but then we broke above. So this was a false breakdown in my mind, where you have this expanding, I guess, funnel pattern. We break above, and we're continuing to see positive price action. So a strong few months once we broke back into this consolidation, move higher, another what looks to be false breakdown, and then more strong price action. So at least on this chart, I think things look good for gold. Why don't we look at the nominal gold price chart, since we're here on the topic of gold. I know I'm jumping around a lot. So gold has been in the consolidation, obviously, since July 2020. It's barely broken new all-time nominal highs. But recently, where's this, like the false breakout that breakdown that correlated to that other chart happened around this time period, where this was the lowest. You could see 1680 or so was a pretty firm bottom. One reaction, two reactions, three reactions, four reactions. So when it finally broke below, that had people pretty concerned. It didn't quite make sense because it didn't look like the economy was really falling apart during that time. And sure enough, it was a false breakdown. So it came, basically bottomed out there and hasn't made a new lower low since then. It's just been higher lows or equal lows. So here was another interesting sort of what I see to be a trap, is that we had this consolidation period, and it, like, you really get excited when you go on the daily chart. Very clean trend lines were followed, and then we broke down, and this again looked bad for gold, but then it popped right back above, and so now we're ripping higher again. So I I know there's been plenty of people who've called the bottom in gold and said, okay, now we're going higher. We have a triple top, and gold still hasn't given up its price action. In addition, it's had very strong price action recently, very strong up moves, a lot of false breakdowns. From what I can tell is in the next month or two, we're breaking 2000 or breaking all-time highs. And gold won't look back until probably, if you want to be conservative, probably something like this would happen. So like 2400, 2500 would be the next target for gold once it does actually break out. So how does that work if we're going into a huge global recession? I don't know. So I think that's the biggest, I guess the biggest opponent to my bear case is that gold usually does not rip while the rest of the market is tanking. Usually it drops first and bottoms first. Or it drops at the very beginning and then bottoms before everything else, and then it rips higher. Right now, what we're seeing is gold looks like it's ready to rip higher, and the market has barely topped out. So there's a few potential arguments for why this is. One is that treasuries are no longer the safe haven, it's gold. And with all the uncertainty in the world, people are flocking to gold. That could be possible. I'm not sure how realistic it is once things really get bad. Does gold really make sense as an alternative to treasury yields? It's sort of like the Bitcoin argument. You don't know if it's a good alternative until you actually see it. Although I don't think Bitcoin is going to be, the safe haven for, governments. It might be the safe haven for individuals, not for governments. Gold could potentially be a safe haven for both. Larger institutions, governments, pretty much everyone. So that's why I'm long-term positive on gold, is because there's so much long-term turmoil ahead, and because the currencies are so uncertain, people are probably going to be wanting to pile into gold more and more over the coming decade. Okay, with that said, are there any other charts that are worth looking at? I guess moving back to ratio charts, the oil to M2 money supply chart is interesting to look at. We've sort of had a downtrend over the last, from 2008 to 2020. We broke out. It looks like we've come very close to retesting the breakout trend line, and we might be going higher. So this is another thing where if a big recession is coming, why does the oil price look so strong? It could be a stagflationary recession where maybe markets don't completely collapse. Maybe they just trend lower, enter a sort of normal bear market over time. There's no huge demand destroying event. Things just don't do very well for even if just big tech enters a bear market, then the rest of the market enters a bear market because they're so heavily weighted. Like, that's all that needs to happen for us to be in a bear market, is us to have an earnings recession and big tech enters sort of bear trend for a while. That's largely what happened in 2022. Big tech valuations got cut really badly, and the entire market suffered. But that is notable here, is that we basically have, if you look at compared to money supply, crude oil is still very cheap, which is a little concerning for the average consumer who can barely afford to pay for gas right now. because it could get a lot more expensive, and that wouldn't even be, something technically to be surprised at. If you look at copper to M2 money supply, sort of similar picture where it's kind of in the middle of the range in terms of being cheap, but it's the price has been kind of becoming narrower and narrower, consolidating. So I expect a breakout probably to the upside in the next few years. Yeah, like not very certain on copper. I think that's a longer term play if it is a play at all. I think it could be a good play, but something longer term. NASDAQ to S&P. This is another interesting one. You can see the NASDAQ became higher valued than the S&P than the peak of the dot-com bubble compared to the S&P in 2020 and 2021. It then broke down, had terrible underperformance, and then bounced back. You can see this was my original prediction. It didn't quite play out. We bottomed earlier than I expected. But we've ripped back and we're up to those high valuation levels again. This isn't a definite topping pattern that I'm seeing here, but it's potentially a topping pattern. This is sort of a 50-50 thing. Like usually you see higher price swings if it is a topping pattern. This has been narrow, so possible we see another squeeze up, maybe to the top of this range, whatever this top trend line is, before more of a real top comes in. I would be very surprised if it broke above this range. IWM to SPX. This is something else that shows we're potentially at a turning point, and that is because, this chart only goes back to about 2000, but since then we've only had a few times when or almost every time we've come to these levels around where we're at right now, we have bounced. So I think I expect a bounce to come. Will it hold above this? That's a different question. Like, it could bounce and then break down after, a few weeks or months. Especially if we're entering into like a sort of new kind of paradigm in terms of market valuations and inflation and all that stuff. But at the very least, I think we should get a significant bounce before a breakdown. So that's something we're waiting on. Right now, it looks like probably a good time to buy IWM compared to S&P. Now, gold to S&P. This is another chart that has been relatively, in a relative downtrend since, forever ago, 1912, 1979 here, 2011 here. We've been in a relative downtrend. Could that be changing? If we enter 40 years of economic turmoil, of world turmoil, then sure, probably gold breaks out of this pattern and, we can see 1970s level valuations again in, the next few decades. For now, though, we've got a fairly clear trend line right here, or a fairly clear level of support here that most of the time we've spent above. And in 2022, we broke below that briefly. But since then, we've recovered and remained above. We're near trend line resistance, so maybe gold takes a break for a while. If we break back into this, then we probably surge quite a bit higher. Crude oil compared to the S&P, similar to gold, it's been in a big downtrend. That kind of makes sense. In general, I think investing in technology will pay off more than investing in natural resources, but there are periods of time where natural resources outperform, as in 2000 to 2008. Copper to S&P. You can see it's been in, looks like less of a downtrend and more of a consolidation period for forever. And right now it's at the bottom of the bottom of this, I guess, lower trend line. So right now looks like a very good time to, buy copper, short S&P. Bitcoin to NASDAQ. This is interesting. What it shows, I guess, is that we've been in a general uptrend. Bitcoin has outperformed just about everything. But the uptrend becomes less and less extreme over time. So you can see, this 2017 to 2020, a lot of consolidation, big outperformance. And now, I wonder if this comes out to here. Maybe we see something like this. I'm not really sure what to make of this, so we're just going to have to wait and see. But it is interesting that this trend line, since 2018, we've been below it recently and has not broken above yet. Gold to silver ratio. This is another chart that's pretty much range bound since it begins. What you can see is we saw all-time high in 2020, and there's this other trend line, or I guess rising channel, that rising wedge, that in 2022 we retested after breaking down from. We've kind of been sideways since then. It looks like there's this funnel pattern that we may break out of to the upside. So maybe it will, be some pretty extreme valuations of gold compared to silver again soon. If this breaks down, that probably means the gold bull market is in full swing, because as the gold bull markets proceed, silver tends to outperform by a significant margin. So you should see this going down as we're in a gold bull market, or in a at least upturn in that market. Copper to gold, another ratio that's kind of been steady, although it's been a lot more, it's hard to make a significant trends here. You can see recently we've had this, since 2010, this upper trend line that we broke above, broke below, or broke back into, which is usually pretty bearish. And then since then we've been on a bit of a downtrend. So gold or copper has been underperforming gold. I probably would not be too interested in copper until we're at the bottom of this trend, or to this lower trend line. Is it possible that it breaks out? Yes, it is. But I think after having a false breakout already, chances are you're going to at least test the other trend line of the trend channel first. Wheat to gold. This is interesting. It shows that wheat has become less and less valuable over time. Makes sense. We've been more productive in terms of our food creating capacity. We reached an all-time low in August of 2020, and so far we're coming close to retesting those lows. So it may be a good time to buy wheat. Crude oil to gold. This has been interesting. Again, like something that's surprising about a lot of these ratio charts is that they follow such clean channels. This crude oil compared to gold has had a breakout and then a breakdown, and then now we've broken out again. So who knows where this ends up going next? The expectations have been sort of, or abnormal technical analysis have some sort of been negated. So yeah, I don't really have a great insight on that. Maybe you could argue, oh, I just got the trend line wrong. It didn't break down. This just had a short false breakout and then break down. So maybe that's more of what the picture is here, is that this was a false breakout, not part of the trend line. This is where the woo-woo part of technical analysis comes in, where it's all pretty much subjective, not very many super objective parts of it, or not very much is super objective to technical analysis. So if we did have that breakdown, and then now this is the real breakout to the upside, then I could see this happening, which would mean that gold should outperform, crude oil should outperform gold, which is typically what happens when crude oil is performing well. Let's see. TLT to junk bonds. Oh yeah, that's another thing might be worth covering, is junk bonds. TLT, treasury bonds, have been relatively close to junk bonds in performance, or they followed narrow range. 2022 they broke down from this sort of slight uptrend line, meaning people value government bonds a lot less than they did previously compared to junk bonds. And this volume, I don't know what that is referring to, so I would not pay attention to that. But if we go back to junk bonds, JNK, this is something else that's sort of significant that's happened, is lower trend line isn't super clear, but you can see the mid and upper trend lines here. Actually, all these drawings are kind of a mess. What's not a mess is this narrowing rising wedge that we've been in until I guess September of this year, and then we've broken down from that. So how far this comes down, we'll have to see, but it has broken down, which means at least for now, junk bonds are in downtrend, means people are taking a more risk-off mindset. Let's see, what else? All right. This is more for shorter term sake. Well, short to mid-term sake. Since the market is more or less driven by big tech, let's look at the big tech charts. This is Apple. And you can see, except for this period here, we've been kind of in this range, uptrend range. We formed a mild downward channel, or downtrend channel, 2021 to 2022. We've broken out of that and made a new all-time high. Now we are in what looks like it could be a bull flag. I don't think it is because of the volatility in the price range. It's had a lot of big chops up and chops down. You could also interpret this as sort of a rolling top. Um, to me, it's hard to say. I don't have that much conviction in the direction this goes next. Like, it could be a topping pattern, it could be a bull flag pattern from what I can see. What I would expected if it was a topping pattern is maybe at this point, instead of making another, move up, at this point it flushes down, then I would have been more confident in this being bearish. But for now, I'm kind of neutral. It could go either way. Maybe this is a small part of a bigger topping pattern. And actually, that might be more of my base case. Maybe we make it all the way to 200 and then come down. Microsoft, similar to what Apple is doing in that we've got this consolidation going after making a slightly higher high. This looks like it could be a bull flag, before it rips higher. What is interesting about Microsoft is this long-term trend line going back to 2016 has been broken to the downside. We tried to recover it. It did not recover, or I guess it failed the recovery, which is generally bearish. But with the time frame this long, it could make another push up before before it really sells off. So it could still be an uptrend for a little longer. But generally, we're looking for it to turn down. What I do find interesting is that, I guess this is hard to say, because we did, this was something I was looking at, is the potential upper trend line, but we did break above it, which kind of invalidates it. What was interesting was that it had a false breakout out of that trend line on earnings, and then it's back into this range. So it's hard to argue that this is short-term a topping pattern. Maybe it is a longer, more drawn-out topping pattern, or starting of a longer, more drawn-out topping pattern, where eventually this does succeed in breaking out. Maybe it retests the all-time highs, and then later on breaks down. It's just, to me, hard to argue that this is a definite topping pattern right now. Google, on the other hand, might be a different story. And the reason I say that is because we had this rising wedge, and then we broke out of it, and huge flush down from there. Still, if this is a topping pattern, I would kind of expect it to last a little bit longer. Maybe we come up and try to make new highs first, and then flush down later on. So Amazon looks more like it had a topping pattern, and then it had a false breakdown here where it sold off into earnings, and then earnings ended up being better than expected, and it recovered. So the one pattern that I would have thought was a topping pattern has failed to break down properly. So I guess it's wait and see for now. I would be unsurprised if Apple now, like a lot of times in uptrends, you sort of form a topping pattern, or what looks like might be a topping pattern, break down, recover, and then that's when the next bull leg starts. That's why these things can be so tricky, is because if you're looking at technicals alone, there's traps all over the place, from the classic textbook patterns. So yeah, I would be unsurprised if this makes another move up from here. Tesla, we've had what looked to be a topping, like a very definite topping pattern. Big flush down, so kind of satisfied that. And then since then, we've been in this uptrend that we recently broke pretty significantly to the downside. So now Tesla is looking like it's starting a new downtrend. Um, but it could be towards the bottom. Like, it's not clear yet. Maybe we extend this out, and then maybe this becomes just sort of a consolidation downtrend and then eventually breaks out again. So we'll see on Tesla. Facebook looks like it could be in a topping pattern. We have a double top there, bearish divergence on the weekly, but no break yet, or no breakdown yet. In fact, we did break down below this sort of trend line, so maybe it's bearish. I would lean towards being bearish on this one. It's doing a retest here, failure to, retake the trend line last Friday. So, yeah, I'm generally bearish on Facebook. Nvidia, similar picture, is that this looks closer to a topping pattern with the kind of this volatility here after a big gap up. We failed to make new highs, and it looks like a rolling top. It kind of has all the aspects of a topping pattern that I would look for. Especially, high volume sell-offs near local tops. And recently we've broken down this trend line. Like, we're still holding horizontal support, which I could show. We're still basically holding this horizontal support, but that's only, 1-2 reactions. The trend line support broke, and we're below that now. So I think my expectation is that eventually, within the next couple months, we fill this gap. And I don't think it's going to be that hard to fill because we got such a sort of vacuum within the gap, or, it's such a large gap. And there's like no price action except for a little bit back here that's in between the gap and current prices. So this could be a very rapid gap fill, which I would see. So overall, on the big tech stocks, you can even go to this one. This shows, I guess, the big top 5 FANG stocks. They used to be top 5. I don't know if they're top 5 anymore. I don't think they really are. But basically what I'm seeing is there's a possibility of things going either way. I'm overall probably kind of neutral for tech stocks, unless I guess the big thing I would want to see to become bearish on these would be like this trend line being broken to the downside, and then overall I would probably be shifting bearish. Otherwise it seems like 50-50. Half of them look like it could go either way or up, the other half look kind of bearish. So we'll just have to see where they go. I also wanted to quickly touch on the energy stocks. The XLE and XOP are the big energy producers. This looks so much like a topping pattern to me. You've got kind of the volatility grinding up this rising wedge, sort of a head and shoulders pattern. So no guarantees, but I think if this trend line gets broken to the downside, then this XLE could flush down in a big way. XOP kind of looks, gosh, if you turn this off, kind of look similar. We've failed to make new highs even after all these attempts. 1, 2, 3 attempts. So triple top. Um, looks like kind of seeing something like that. Something like that. It's actually narrowing, so who knows for XOP. Doesn't look quite as toppy to me. But are sort of following this trend line here. If this breaks out to the upside, then it's bullish. If it breaks to the downside, then it's bearish. That's my opinion. With what's going on right now in terms of recession possibility, I would be hesitant to get into this, but I have had very little luck playing oil in general. It just doesn't seem to work for me. XLF, the financials. Actually, I wanted to go through a lot of different individual financial stocks just to see what the sort of mood is in the financial sector. We have not made a new high since 2022 on this. Not too surprising given that with how much interest rates are rising, people are probably not too optimistic on banks. Okay, so I just made this trend line. I don't know if that's super legit, but if it does really actually break down to the downside, like for more than a week or so, this could be bad. I think I think this is one that's kind of hard to read because it's in such a sideways range. Like, just technically alone, I could see it going either way, meaning I have no idea what's going on. Bank of America has been in an uptrend for a while, since 2009. It has broken the uptrend recently. So the general sense is over the next few years, I would expect this to enter, a sideways or downtrend. Or Citibank, same thing basically. We kind of had a breakdown in 2020, but we've got more of a sustained breakdown recently. So banks don't look to be performing well, or at least these types of banks. JPM, this is kind of considered the best of the best. Still doing decently, but not really in a strong uptrend from what I can tell right now. Wells Fargo, similar to JP Morgan. Okay, the credit card companies are concerning. We've seen American Express kind of have a blow off top in the 2021-2022 period, and since then it's kind of at the top of the range, but I could expect it to go to the bottom of range and even break down. COF, Capital One Financial, same thing. We had a blow off top, and now we're kind of consolidating up here. My expectation is the next move is down. The reason for that is, in general, if you have such a big top that breaks over a trend line and then breaks back into the trend line, usually the real move is the other side. So Discover, same thing, blow off top, except for this thing. This time it's doing so poorly that it's actually broken to the downside after having its big blow off top. So it is down, 37% from the top. That's huge for such a big company. one that's considered more stable. MasterCard, same thing. Long-term trend channel has broken down. No blow off top for this one though. PayPal. Okay, PayPal is just in the dump. Visa. Also 2022, it's broken down from its trend line, so kind of my expectation is some significant downside. You might even be able to look at, okay, shorter time frame, probably something like this, breaks down. It looks like it probably just broke down here. And so maybe next few weeks even we'll see a big flush down. Let's see, capital markets, Goldman Sachs, kind of sideways consolidation range, still in the uptrend long term. I'm just looking for bigger banks. I don't really care about the smaller ones. Morgan Stanley. I haven't really even charted this one, but I could do that quickly. Maybe something like this. Kind of hard to tell on the top one. So this is sort of what I kind of see is this probably was a topping pattern, but we do have horizontal support here that it has to break down below before I would be really bearish. If it does, then probably big flush down, maybe 20-30%. Charles Schwab has done, it's already had a big kind of crash, 37%, and it's kind of hugging the top of this trend line for now. If it breaks down from here, could be in for another big flush down. CBOE, I think these are more of exchanges. CBOE global markets. They've been doing well, from what I can tell. Although this has been just going sideways since 2019, CME. All right. Okay. Kind of running out of steam here. I think that one last thing I wanted to talk about was the debt for the U.S. That I think is completely unsustainable at higher interest rates. And so the question is, what will happen to the what will happen to the way the country handles debt? So you can see here that this is sort of the government spending over the last, since 2006. And then you have the revenue in red. So blue is just government spending. And obviously this only goes up to present time, so 2023, late 2023. And you can see that spending has been outpacing revenue. And when I say revenue, that's like tax receipts, which means, oh yeah, and at the same time, interest rates have been going down. If you recall, since 1981, 1982, interest rates have been in a steady downtrend. So you can see how even though spending has outpaced revenue, meaning the government debt has been increasing year after year, you've had interest payments that have been relatively flat all the way up until 2021. Once rate hikes started, you've seen this explosion. And this is 2023. So this is the last real data point right here. But you can see it's still like clearly broken trend. And I guess my point with this chart was that if you continue raising interest rates, right now I think it's showing like a 3%. Let's see, effective interest rate of at 2023 is 2.71. That's the effective interest payment they're making. If we increase this continually to, over the next 10 years, so that means till 2030 up to 5.48%, which isn't that unreasonable, then by 2030 we will have interest payments that exceed tax revenue. And this isn't assuming like linear growth in revenue, linear growth in spending. So I think these are pretty reasonable assumptions. We're at that point where the point of kind of no return, where the debt is truly becoming unsustainable, or our deficit spending is truly becoming unsustainable. So I think there are a few options, and I think like Lynn Alden kind of explains it the best, and that is basically real interest rates on government debt has to be negative. That's the only way this level of spending is sustainable, meaning that you can either have high inflation and relatively low interest rates. Like let's say inflation is 20%, interest rates on that the government pays on its debt is around 10%. If the economy continues to grow, meaning it doesn't go into a crazy big depression, then I think payments will be sustainable. But if inflation is say 20% and interest rates that the government has to pay on the debt are 25%, then it's unsustainable. That's, I think, the simple math here. But who's going to buy negative yielding government debt? It might happen for, a few more years as countries and, institutions don't really have good alternatives. But they're going to be looking for, I think, better alternatives once they realize that this negative yielding debt is here to stay. And which means that possibly the Federal Reserve absorbs that by basically, buying all the excess debt in order to keep rates at a certain level. So some sort of form of, I think that's yield control, basically controlling interest rates on debt by paying or buying up all the excess debt, being basically the source of demand when there is no other source. I think that's really the only way out of this, because if you use the other method, which is let's spend less in order to have spending that's lower than our revenue, yes, I think that would keep interest rates down, but it would also, because basically you have supply of debt going to the ground, and so people would know that their debt that they're buying is positive yielding, but that would create a huge, I think, unprecedented depression, and revenues would also tank. So the question would be, can you lower spending? Like, you would have to lower spending to such a low level because of the amount that tax revenues would shrink, that the country would look very different at the other end of that after 5, 10, 15, 20 years, once as long as it takes to get the debt looking more manageable, and I just don't see that happening. Like, government officials are not going to, be on board with laying off um, half of government workers in order to make that happen, including all the military industrial complex stuff. So my base case is the only way out of this is spending our way out, spending faster than, or spending and not having to pay for the increase um, in inflation that spending causes. So basically, you're effectively increasing taxes on the people significantly, but there's no way out of that increase except for to get into safe haven assets. So, whatever that safe haven ends up being, probably commodities, probably natural resources will be the safe haven, especially if all this increased government spending goes into industrial things like, infrastructure for the country, more onshoring of industry, even war is inflationary. So I think that's the main way. I think that's a large reason that commodities are expected to do well over the next couple decades, is just because a lot of spending will go into things that require commodities. The other half of the equation is the fact that commodities have been very underinvested in, so supply is not going to be increasing at the rate it needs to be anytime soon, and there's a big lag effect. So usually the price surge comes, and then a few years later the supply that comes online follows, and that's why there's like 10 plus year boom bust cycles for commodities. It just takes a few years after the price increases for the commodity producers to catch up and increase the supply to meet that increased demand. Anyways, this has been a long one. Probably will disappear for the next 2 years. So that's it for me.